Hey guys, so another video like this. You seem to like the last one, so I'm going to be trying and doing a few more of these. If you do like these videos, I'm hopefully going to be putting out one or two of these onto my YouTube channel each week, and then a few more onto my Patreon as well. So if you want, check that out. It'll be down in the description, link for the Patreon. There's a bunch of other stuff with it as well. Today we're going to talk a little bit about CPI, obviously pretty big news, what came out yesterday. What the Fed have said about it. They released a financial stability report that's quite interesting, and they've got some concerns as well, so we're going to cover that. And then at the end, we're just going to touch on Elon and what seems to have happened with his Tesla shares so far. Right, so the Fed released what we're calling a global stability report, and they do it, I think, every quarter. And in short, they just recount and discuss, explain any kind of issues that they foresee happening with the markets. And surprise, surprise, some issues came up. So the issues that they raised are important ones that I'm going to cover, and I'm going to come out with longer videos that go more in depth on each of these issues. But the first one is Evergrande Contagion, which in reality isn't actually Evergrande Contagion, it's Chinese property market contagion. Evergrande is just one company. It's not the only one that matters. There are a bunch out there, and there are a bunch that are seeing problems, defaults happening all over. The other problem that they're seeing is overvalued markets, surprise, surprise. Specifically overvalued in terms of forward PE and PS ratios and things like that, which is kind of difficult. Sorry, the dog's running past. Kind of difficult for a lot of people, especially those who are, really invested into tech or hype stocks, to get their heads around, because their whole arguments for these high valuations are that in the future these companies will meet revenue expectations, but even if they do reach those revenue expectations, they'll still be overvalued. That's basically what the Fed is saying, and that's a bit worrying for them as well. Quick apology here, I did pick up a gimbal, not a cheap one either. I spent like $500 on this, but it's still a bit crap, or I'm still learning how to use it. So it's spinning, and I have a feeling it's going to stop working in a moment, so the quality may drop off a cliff. Sorry for that in advance. Regarding this whole Chinese property developer contagion, there's been another couple defaults in recent weeks. Cynic and Fantasia have, found themselves in the same situation that Evergrande's in. Evergrande has somehow managed to continue to stave off actually defaulting, while also missing loads of bond payments that are due. It's a shell of a company. It's a zombie. It's not going to survive. It's just liquidating all assets to pay off these debts, and it can't continue this forever at all. It's just not going to happen. So in particular, Kaiser Group have just found themselves in a similar situation to Evergrande and Cynic and Fantasia and all the others, and the Feds are starting to get a little bit worried about all of that and the potential contagion to the rest of the world. What they basically said is that as these developers continue to perform poorly and default, global risk tolerance could change, and that could impact financial markets all over the world, in the US, in China, in Europe, and everywhere else as well. The impact of these, the collapse in bond prices and things, it's now starting to affect less levered up Chinese developers, and also other Chinese corporate companies as well. Companies like Tencent, companies that we didn't expect to see, or well, the Fed didn't expect to see problems with, at least so soon. And this is all happening at the same time as the Chinese economy as a whole is on an edge. They've obviously got a really bad energy crisis that makes the one in Europe look tame in comparison. They've got their CCP crackdowns hampering consumer sentiment across the country, and developer after developer are starting to default, and the housing market in China is looking like it's on edge as well. So the Fed are worried about contagion from the Chinese markets in that sense. In particular, again, the Fed spoke about high valuations in comparison to their expected future cash flows. And the problem with this is that it's not even their current cash flows, it's expected. So that relies on a whole bunch of other contingencies, like the markets continuing to perform well, consumer sentiment staying high, growth for these companies continuing as is expected. So, high forward PEs and PSs are a little bit frothy and a little bit bubbly, and the Fed is starting to take note. You and I might say, well, it's about time they took note, but it would have been nice if they had commented on this 6 months ago, and yeah, it would have, but what are you going to do? They did also note that asset prices could significantly decline, I think is the words they used. So again, they're sort of paving the way for, oh no, we might have been wrong, let's try and cover our asses a little bit. Finally, the Fed also spoke about meme stocks, crypto investors and retail investors in general, and they've shown that they've looked into the data and they've realized that when retail investors start to take on more and more risk because they feel like stocks only go up, that could be the sign that we're in a bubble. This measure that they've created peaked in 2001 with the dot-com bubble, and then it fell after then, and then slowly rose in 2008, but then crashed a little bit quickly, and it's now on its way back up to 2001 levels. So that's a little bit worrying as well. In my mind, this is kind of relevant to that whole, the old adage that you've probably heard with various different mannerisms. When your shoe shine boy or the elevator operator or the taxi driver starts giving you stock tips, it's time to get out of the market. Now we can adapt this for the modern day. When the drug dealers start giving you NFT tips, maybe it's time to get out of the markets. That's sort of what I feel the Fed is hinting at here. Retail investors are getting too confident. They think they're all geniuses because everyone makes money in the bull market, and they think that stocks, crypto, NFTs only go up, which of course we know is just not the case. So the next big issue is obviously inflation. CPI data came out yesterday and it was bad, really quite bad. 0.9% month over month, I think 6.2% year over year, which is I think the highest in almost 30 years. I think the last time it was this high was 1991 or something like that. So obviously that data's bad. Quick thing, a lot of people have been saying that 0.9% is 10% annualized. It's not, it's 11.3%. You know, things like this compound, just like interest compounds. It isn't just 0.9 times 12, it's 0.9 times 0.9 times 0.9 times 0.9, you know, 12 times, or to the power of 12. So it's actually a little bit worse than some people are making out. 11.3% annualized, not 10. So really not good news at all. The energy index as well rose 30%. I put out a video on this yesterday. I talked about the energy crisis that is worldwide, how it's impacting everywhere, including the US, despite the fact that some people think they're sort of getting off scot-free. They're not. There are problems there as well. Okay, so really sorry if the quality's just got worse, if it's a little bit more jolty. The gimbal just started spinning, so I had to take that off. Christ, sometimes I hate technology. Anyway, as I was saying, I don't really expect the Fed's tapering to change much from this. They've already set out their road plan, and it actually doesn't go too far into the future. If they do choose to change it, it's only going to make an impact of, you know, something like $5 or $10 billion in mortgage-backed securities, and in comparison to what they've printed over the last year and a half, that's absolutely pennies. It's not going to stop inflation from swelling up anymore. So I expect them to stick firm with their tapering, or at least not change it yet. I do, on the other hand, think that interest rate rises are on the table much sooner than they were previously. Prior to this, it seemed like the consensus was no rate rises until 2023. I think we're probably looking at mid-2022 if data continues like this. It's just not very feasible to let 0.9 inflation, you know, mount up month after month, especially after we've already had a year of 6% inflation. I read a pretty interesting article documenting why this author thinks we found ourselves in this trouble, and I'm going to be taking that and making a video in the next few days about why I think we're in this trouble with inflation and interest rate rises and things. But in short, it comes down to the fact that there's been a change in the school of thought of what is acceptable levels of debt for a government. We used to measure debt in terms of debt to GDP, but we've sort of changed to debt servicing to GDP, which means we're measuring the interest payments, the repayments on that debt, as opposed to the principal. And the idea behind that is that people sort of thought low interest rates would last forever, which they obviously haven't, or they have so far, but they're not going to. So the US government, and actually pretty much all Western governments, are in quite a big pickle. They've all increased their spending recently. They've all started spending more. They've kept interest rates very, very low. And so these governments have sort of tricked themselves into believing that we're seeing loads of growth in our economy because the economy is just booming, and it has nothing to do with really low interest rates. But of course, that's not really the case. You know, interest rates at 0% or 1% for a decade are the reason that we've seen all this growth. And when those rates rise, that growth's probably going to stop or significantly slow down as well. And now on to the final topic. We're going back to Elon. So it's pretty much emerged that Elon sold 2.5% of his shares, of his Tesla shares, or about a quarter of the position that he announced he was going to sell. As of right now, I think Tesla's trading pre-market at $1,096, something like that. So it's down about 10% from a week ago or its peak, and Elon has offloaded a quarter of his position. So as he continues to offload shares, we can expect the price to fall a little bit more. To be honest, I think there's been a lot more buying pressure than most people expected. There seem to be a lot of people picking up the slack where Elon's leaving off and keeping the price relatively high. I mean, the share price is practically $1,100. That's still insanely high. It's still far higher than it was a month ago, or 2 months ago, or 3 months ago. So I can't help but think that actually sentiment for Tesla stock hasn't really changed on this news at all. It has now also been pretty much confirmed that Elon, didn't really do this because of the Twitter poll. The Twitter poll was just his way of buying himself some goodwill, as we expected. This was really all about his stock options that are going to cause him to have a hell of a lot of tax liability in the future, and he needs cash for it. So he's going to liquidate some shares, get the cash so that he can exercise these stock options when they come due. Yeah, that's pretty much it for the video. I like doing these, and you guys seem to like watching these, so I'm going to be hopefully putting out 1 or 2 of these on my YouTube channel each week, and then another 3 or so onto my Patreon that's going to be exclusive for those members. So if you want that, if you like these videos, if you want more of them, check out the Patreon. There's going to be a bunch of other content as well. I post access to all the paywalled articles that I use in my videos, so if you're stuck behind the Wall Street Journal's paywall, well, if you're a Patreon member, you can read that article on my page instead. We also do other things. I'm going to start live streaming soon enough, in a couple of weeks, once I get my new office set up. I'm moving house on Monday, so I'm a little bit hectic right now, but I'm trying to keep videos coming out for you guys. As always, links in the description for affiliates. I think we've got BLOCKFI at the moment, that's pretty much it. And the Patreon. Thanks for watching. Oh, I think you guys like to look at the dogs, don't you? Some of you wanted to see more dogs. So here's Lottie. Young one and old one, and the beautiful English countryside. I just realised you probably couldn't hear me when I turned the camera around there. This is a forward-facing mic. Anyway, thanks for watching. Thanks for all the support recently. I'm going to put more of these videos out, as I said earlier. Until next time, stay stoic.